On March 31, 2001, Swissair grounded its entire fleet, a move that sent shockwaves through the aviation world and marked the abrupt end of a carrier once hailed as the Flying Bank. Founded in 1931 as the national airline of a tiny, neutral nation perched between Europe's great powers, Swissair grew from a modest regional service into a symbol of Swiss precision, reliability, and financial prudence. By the 1990s, the airline's balance sheets glittered, its brand appeared on glossy magazine spreads, and the nickname Flying Bank seemed more than a clever moniker. It felt like a promise that the carrier could weather any storm. The story of that promise begins in the aftermath of World War II, when Switzerland's unique geopolitical stance allowed its airline to expand unhindered by the devastation that crippled its neighbors. Swissair secured coveted landing rights at key European hubs, forged a reputation for punctuality, and invested heavily in a modern fleet of jetliners. In 1960, the airline introduced its iconic Swiss International Airlines branding, a sleek white dove against a red backdrop that would become synonymous with Swiss excellence. By the 1970s, Swissair's network spanned 5 continents, and its profits consistently outpaced those of larger competitors, reinforcing the myth of an invincible cash-rich carrier. The 1990s brought an era of rapid consolidation across the airline industry. Low-cost carriers emerged, legacy airlines merged, and alliances reshaped global travel. Swissair, eager to preserve its market share, embarked on an aggressive expansion strategy that would sow the seeds of its downfall. In 1996, the airline announced the Hunter strategy, a bold plan to acquire stakes in several European carriers, Austrian Airlines, Sabena, LOT Polish Airlines, and a minority share in Brussels-based Sabena, alongside a partnership with the newly formed airline group Swissair Europe. The goal was clear: build a pan-European network without relinquishing control, thereby positioning Swissair as the linchpin of a European airline alliance. On paper, the Hunter strategy looked like a masterstroke. Each partner brought valuable routes, airport slots, and brand equity, promising a future where Swissair could dominate the continent's most lucrative corridors. Yet the reality was far less rosy. The acquisitions were financed largely through debt, and many of the target airlines were already struggling financially. Sabena, for example, carried a heavy legacy of overcapacity and aging aircraft. LOT was burdened by a post-communist transition fraught with inefficiencies. Swissair's leadership, confident in its reputation as a bank with deep reserves, underestimated the hidden liabilities that accompanied each purchase. Warning signs began to surface in the late 1990s. Internal auditors flagged mounting interest payments, while analysts noted a sharp increase in the airline's leverage ratio, from a comfortable 2.5 to 1 in 1995 to an alarming 6 to 1 by 1999. The balance sheet, once a model of stability, now displayed a growing chasm between assets and obligations. Meanwhile, operational challenges mounted. Integrating disparate reservation systems, reconciling differing labor contracts, and harmonizing fleet maintenance across multiple countries stretched Swissair's management capacity to its limits. Passengers started experiencing delayed flights and inconsistent service, eroding the brand's legendary reliability. The external environment compounded the strain. The Asian financial crisis of 1997 and the dot-com bubble burst in 2000 led to a slump in business travel, the very revenue stream that had long underpinned Swissair's profitability. Fuel prices surged, and competition from low-cost airlines like Ryanair and EasyJet ate into market share on short-haul routes. In the summer of 2000, Swissair announced a costly restructuring plan that included workforce reductions and the retirement of older aircraft, a plan that required immediate cash infusion to succeed. By early 2001, the situation had become untenable. Creditors demanded repayment, and the airline's cash reserves were rapidly depleting. On February 27, 2001, Swissair's board voted to request a massive Euros 1.3 billion loan from the Swiss government, hoping to bridge the liquidity gap and complete the restructuring. The government, wary of bailing out a private enterprise, placed the airline under strict financial oversight. Within days, a consortium of banks and investors withdrew their support, citing the airline's unsustainable debt load and the lack of a clear path to profitability. The final blow came on March 31, when Swissair announced that it could no longer meet its financial obligations and would cease operations immediately. The decision forced the grounding of 55 aircraft, leaving thousands of passengers stranded across 5 continents and leaving 18,000 employees facing an uncertain future. The sight of a Swissair jet sitting idle on the tarmac of Zurich Airport, its red and white livery faded, its engine silent, became an emblem of a nation's collective shock. In the aftermath, the Swiss government orchestrated a swift rescue of the airline's core assets, merging them with the struggling regional carrier Crossair to form Swiss International Airlines. This new entity, backed by the state and later acquired by the Lufthansa Group, inherited Swissair's valuable slots at major airports and its reputation for safety, but it also carried the burden of the scandal that had toppled its predecessor. Sabena, one of the most high-profile victims of the Hunter strategy, declared bankruptcy in 2001, and LOT struggled for years before stabilizing under new ownership. Austrian Airlines, despite initial turmoil, eventually found a lifeline through a partnership with the Lufthansa Group. The Swissair saga left lasting lessons for the aviation industry. It demonstrated how a brand built on perceived financial strength could be undermined by overambitious expansion, poor due diligence, and an underestimation of external economic forces. Subscribe to The Collapse for more stories like this.